Good morning, guys. It's been a long time since I have uploaded a video. So today we'll talk about different methods to confirm entries. How to confirm your entry. So look at this. There are over 6 to 7 confirmations that you can take from these levels. Okay. So let's discuss about each confirmation for about the basics of these entries. So in volume, how can you take confirmations? In volume, you can see there is a volume trend. When the volume trend is there, the volume will be above, a little bit above or absolute on point of your average, volume average. Okay. And then when the volume is about to end, like when the volume is too high, like it's called volume climax. When you see huge volume at a point with other trading confluences, you need to keep this in mind. With other trading confluences, that is where you can anticipate a reversal, which means it is called volume climax. Whatever the orders that needs to be filled, they are filled. So that is the area where you can see a little bit of retracement or a reversal trade or any other. See, when the volume is just above average, not too huge, the market trends. When the volume is huge, there is a possibility of market reversals. So at these areas, you need to take confirmations where to enter and which candle to take into consideration. Some people take into consideration like bullish engulfing. Some people take considerations like haramis, and then some other morning stars, evening stars, and whatever the confirmations that you take from the candlesticks and your oscillators. So that is about volume. Remember, when the market is trending, the volume will be not too high. Okay. And the volume will be too high when there is a reversal that is about to happen. So that is number one. Number two is gaps. The gap theory is a little bit complicated. So let me tell you something. I need to draw something here so that you could understand. Let's say that the market is ranging between these two lines. The market is ranging between these two lines. Let's say the market is ranging within these two lines. So it is ranging like this. Okay. So at this level, this is that range. Let's say this is that range. If the next day market opens, the market opens above this level, and sustains for 15 minutes, there is a possibility. At that level, you need to look for volumes as well. Now, remember this. At that particular point, you need to look for volumes. And this is called breakaway gap, which means it has broken away a range or a pattern. Remember, a pattern or a range breaking away and opening above that range and sustaining there for about 1 hour, 15 minutes to 1 hour. That's when you can say that is a breakaway gap. So what happens when a breakaway gap happens? That the market will right away push up, but you don't have to be worried. The market will definitely come down to test this area or any area that is considered as support in this level. So remember that is breakaway gap, and the next one is running gap. So once there is a breakaway gap, the market will try to retrace back to where it has broken the pattern. You know very well, once the market breaks this break, it will come down, retest the area, and then it will start moving up. So when it starts moving up from this point to this point, this is where you will find the gaps, like too many gaps, here gap, here gap, here gap, and those are called runaway gaps. Remember, the first thing that comes is breakaway gap. Identify if there is any pattern. When there is a consolidation, identify if there is a pattern. That's where you will see a breakaway gap. And after breakaway gap happens, there will be a retest. And then the next day or the other day, you will find a runaway gap. And finally, the exhaustion gap, the gap ups, gap ups, gap ups, and gap ups. The market keeps moving up. For this, you can identify simple pivot, just pivot, pivot point area, simple daily pivot. Use the daily pivot as your identification. Once the daily pivot shows you that it opened below than the previous day pivot, then you can consider the market has a little bit of a reversal area at this point and see for an exhaustion gap. Exhaustion gap happens after a uptrend or a downtrend. After a downtrend, the exhaustion gap happens towards the upside, and after an uptrend, the exhaustion gap happens towards the downside. Okay, and trust me, there sometimes the exhaustion gap happens upside as well, and on that day there will be a gap up here. Let's say the market is moving and there will be a gap up here, and the market moves like this at that area, or in a sideways manner, and then finally tries to close at the low of the day. That is something you need to keep an eye. That is an exhaustion gap. If it is too strong trend and there is an exhaustion gap that happens downside and there is a strong candle, then you can say it's a reversal. That happens rarely, but the strongest thing, exhaustion gap, happens after an uptrend. In Indian markets, I'm talking about, there is an up, gap up. There will be a gap up because our people love more money, so they will try to push the price up towards the void, and from there they will start to push the price down so that they can make more money. So this is the gap theory. And next comes the consolidation areas. So now remember, each thing needs to be remembered and they need to be correlated. Keep an eye on, and then now you see I have showed you volume first and then gaps, and now coming to the consolidation areas. So what did I say? In the consolidation areas, you can see there is a parallel channel pattern, and this is where you will see a breakaway gap, and this is where you will see a breakaway gap, because this is a consolidation area. So this breakaway, once the market breaks this, when you can take an entry. These are entry points. These are entry points. So if you see a gap up, you see a little bit retracement to this consolidation area, that's where you will take an entry. Even here, these are the gaps. There are people who trade gaps perfectly. So now you need to identify these consolidation zones and consolidation areas so that you can use these gap ups, breakaways, and stuff, pattern gap ups, or breakouts of the patterns. These are something. I'm not talking about patterns here. Okay. The next one is Fibonacci retracements. The entries. Let's say that there is an up move and you have placed a Fibonacci. So obviously the 50% area or 38% or 62% area is where you will see a reversal or a retracement. So now, once the market has moved to this point, this is where you will have to look at the volumes. The volumes need to be very low at this level and slowly start building when the market is coming down. That is when the market is about to trend to a downside. But in a reversal, in a retracement, the volumes will be low compared to this move. Okay. And in your oscillators, you can see that this move took more time to reach from, let's say, your oscillator is RSI. Let's say your oscillator is RSI. Okay, this is your RSI. Let's say that. And now from here to here, from this point to this point, the RSI moved like this. Okay, but from this point to this point, that is only half of the area. The RSI came to here, this area. Came to this point, that is 30 or 40 or 20, whatever you place your overbought or oversold areas to. And that's when you can confirm that this is a retracement. This is a retracement. Okay, which means when RSI moves towards the trend, it takes longer time to reach from this point to this point. And in a retracement, the RSI moves faster towards the oversold area in an uptrend, so that from here it can move once again. You understand now? These are the areas that you can consider taking an entry. So now these are the Fibonacci ratios. You can these dotted lines are how you need to plot your Fibonacci retracements and extensions. So after an extension, let's say that you have plotted an extension and Fibonacci at 50 Fibonacci in this trend, the market moved up, and at 38 you saw a reversal here, some reversal areas, and at 38% of this move, 38% of this move I'm talking about, from this point to this point, that is 38% reversal. This is where you need to be cautious. There might be a reversal if RSI moved down to the support level at 38%, then it is a strong downtrend. That's when you will place your extension and see where the next exit point is, because Fibonacci retracements, extensions and retracements are very powerful, and they need to be understood perfectly. I'm not giving you classes on Fibonacci retracements and extensions at this point. I'm just giving you the confirmations, how to take confirmations on entry. And now let's say that these are support and resistance areas, and at these levels, let's say the volumes are building up and you saw a little bit of reversal with confirmation from your oscillators and the consolidation zones. There are no gaps. It is within the intraday level. Then you can consider entering here or entering here. We are not supposed to enter here. There are possibilities. Once you get to a point where you can identify the trend, stop loss, and all of the stuff, you can even enter at this level. Once after a retracement, this level has been broken and retested, so you can enter at this level, even at this level, after you mastered support and resistance areas. So until then, enter at resistance or support. Don't enter in the middle of the trend. So now the last and final easiest thing, that is trend line breaks. Now these trend lines are easy, everyone draw them, but the thing is, few people draw them very wrong. Okay, try to make sure that majority of the pivots, pivot highs or pivot lows when it comes to uptrend, and pivot highs when it comes to downtrend, are connected to the trend line. And once the trend line breaks, it will go for a retracement. And check for it. The retracement happens absolutely. And once the retracement happens, okay, you wait and then see if you can draw a trend line. And second time, it did respect. This is your first entry after a retest of this trend line break. This is your first entry. And if at all you miss this, then I want you to wait. It's better to wait for at least 3 touches on this trend line, so that it gives you a strong confirmation that this trend line is valid. And from there, this is your entry. You would have missed this entry, but this one is your entry. And slowly you can exit when you see this sort of W pattern formations at the bottom of the market. And that's when you saw another trend line breaking, and this is where your entry will be. And now coming to the final part, that is Elliott wave. Here I have given few measurements. Okay, these measurements are the basics of Elliott waves. So with this knowledge, like you know right now what or how a breakaway gaps or running gaps or exhaustion gaps happen. You know how the volume reacts at reversals and trend lines. You know how to take confluence areas in oscillators. You know how to take trend line breaks and stuff. Now all you need to know is this one. This one gives you the direction. Don't take Elliott wave as entries and exits. This is for the direction. Okay, direction and the measurements. See, Elliott wave traders, there are many in there. It's not a small subject. So I just want you to know the basics of Elliott waves. And this picture, if you want, you can, save this measurements and do the analysis for yourself, because this is a very big subject. I'm not going into that right now. So that's it, guys. These are the 6 important areas or 6 important methods to identify your entry points. Thank you, guys. That's it for the day. Have fun.